Hello, and thank you for joining us. My name is John Grady. I'm Executive Director of ADISA. And what we're presenting today is a webinar on impact investing. We've chosen as our title, Impact Investing Washed Up or Evolving, What Advisors Need to Know Now. And our thought is to really explore what happens when we sit here as we do at a crossroads with investors, and in particular millennials and Gen Z investors, continuing to express strong interest in aligning capital with environmental, social, and other priorities. And yet the category has faced skepticism, pushback, and questions about standards and measurement. Our webinar examines this context and tries to get at both what the industry is doing to respond to this demand and to deal with some of the questions and concerns that I mentioned have been raised about impact investing generally. Thus, our title, Is It Washed Up or Evolving? We are fortunate to be joined today by Jeff Schaefer, CEO and co-founder of Common Good Capital. Jeff's been at the vanguard of impact investing for years, and his firm is committed to promoting the ideas underlying impact investing. Importantly, for today's purposes, Common Good Capital also sponsors or helps bring to market projects and opportunities that offer investors the chance to consider impact along with other aspects of an investment. Joining us is Ms. Sylvia Kwan, an ADISA board member and CEO and Chief Investment Officer of Ellevest, a firm that focuses on wealth management and financial planning services that are optimized for women. As you'll hear from Sylvia, part of Ellevest's mission is to bring impact investing opportunities to its clients, whether through the firm's global intentional impact portfolios or through various non-public funds and investment strategies that align with client values and desire for impact. So Jeff and Sylvia, thank you very much for joining us today. Let's get right to it. Let's start with defining impact investing. And I'm going to ask you both, Jeff, I'll start with you, to tell me what the term means when we use it, and then we can get into questions of what it means in the marketplace and some of the affiliations that it has in people's minds, perhaps, with ESG investing. So Jeff, I'll start with you.
Thanks, John, for allowing me to be with you here. And Sylvia, it's always a pleasure to be on a panel with you as well. Let me actually start with a definition that is in the marketplace, probably the most widely accepted definition. And then from there, I think myself, and I'm assuming Sylvia might have some nuances to that. So the definition that is out there predominantly is from the GIN, which is the Global Impact Investing Network. And here's how they define it. Investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. So that's what's in the marketplace, and I do agree with it. But let me put a couple nuances to it. First of all, if I was writing this definition, I would make sure that it's very clearly noted that it's about financial return. And the reason why I say that is there's usually confusion when you don't talk about financial return first, then people mistreat this as charity. And that's clearly not the case. And the reason why I'd say that is charity is not looking for, they're looking for non-financial returns, but they're not looking for financial returns. And so that's the only thing I would change for that definition. Now, if I was talking you or in a non-technical way, it's really an investment or strategy to meet your investment goals that also align with your values or passion. And that's kind of it at a high level. I do think there are some very important criteria or elements that as a practitioner, as somebody who does due diligence in the space, I think there's some attributes that also need to go along with that. And so let me throw out a couple things and recognize that you could always substitute a word or two, but generally I would say, number one, there needs to be a financial return. Why is that important? Because if there is not a financial return, then it's a charity. Nothing wrong with charity, but this is trying to attract capital on the investment side. And candidly, if you look at where most of the capital is in the world, it's on the investment side of the world. It's not on the charitable side. The second thing that I would say, it needs to be intentional. The asset manager themselves need to say, yes, not only are we trying to drive financial returns, but these are the non-financial returns that we are trying to impact. And we will give examples, I'm sure, throughout the webinar today. So at the heart of impact investing, you have to have transparency. And in fact, you want transparency because it's not just about financial, it's about these other non-financials as well. And unless you're intentional and transparent, people don't know about them. And the last thing is it needs to be sustainable. And what I mean by that is it needs to be an investment model that can deliver the returns, the financial returns and the non-financial returns over a longer period of time. If that model is not set up to do that as a pure impact investor, you're not really solving the problem. Now, I guess you could make an argument if that investment fundamentally changed the paradigm and changed that problem forever, then it's probably fine that it went away. But impact investing is addressing massive needs and opportunities, in this process.
And thank you, Jeff. Sylvia, what I want to ask you to talk about is the ways in which Jeff's description does or doesn't evoke some of the ESG investing language that in some ways pulled ESG investing down and made it something that folks are not pursuing these days. So what's different about impact investing when it uses many of the same words that people used when they were describing their ESG investing?
Thanks so much for having Jeff and I on this webinar. I completely agree with Jeff's definition of impact investing. I think some of the backlash that we're seeing is around the confusion around terms being used to describe a very large space. I think, let me focus a bit first on impact investing. I think Jeff put it very, very well, that there's a lot of misperceptions about impact investing, that somehow, it's only about charity and not about driving returns. I think there's this misperception that you can't possibly do both. So there needs to be a trade-off. So either you're kind of focused on doing good or you're focused on doing well, but you can't possibly do both. And therefore, if you're doing good, that means that you are giving up returns, and therefore you must not be a good fiduciary to your clients. And I think that's kind of the crux of some of the backlash, is like, oh, well, if you're doing good, then you can't be about returns, and therefore you're not a fiduciary, as we all are in the space. So we believe, first of all, impact investing is still investing. And if it's about investing, it's really about driving market returns, but alongside some kind of positive impact. And we like to say here at LFS that all of your investing has impact. It's just a matter of, does it have the impact that you want it to have? And I think that can be really eye-opening for clients to really think about, because we run into situations where clients, are very philanthropic and they give to certain charities, and then they discover that, oh, wow, I'm giving to all these charities that are doing certain positive things, but on my investment portfolio, I'm actually undoing a lot of that by investing in things that are sort of offsetting the good that I'm doing here. So I think, we talk about impact investing because we're in the space about really having both the financial returns and the positive impact. I think where a lot of the confusion runs, as you alluded to, John, is when you bring in kind of the term ESG, environmental, social, and governance. I think that has definitely gotten a lot of backlash lately. And I think these are actually two separate things. While they are related in the sense that both are attempts to intentionally align investments alongside your values, with ESG investing, I view that as applicable mainly to publicly traded markets, in the sense that you're taking all of the publicly traded companies in the universe. And if you are an ESG investor, the best that you can really do is try to lean into those companies that match your values and avoid those that don't. So it's very much a filtering type of strategy, but as you can tell, there's not much we can do to influence public companies and the policies they have. So with ESG investing, while I do believe over the long term that companies that do right by their customers, by their employees, by their community will, in the long term, outperform their peers that don't. We certainly see examples of that today. But ESG investing could, depending upon an individual's values, mean avoiding whole sectors entirely, like oil and gas, for example. And so, in situations or in periods where traditional energy outperforms, a strategy that's going to avoid oil and gas will fall short, and vice versa. And so, I think those are some of the potential risks of ESG investing, where you are filtering and trying to avoid certain companies or certain sectors. Whereas impact investing, I think, is completely different.
Sylvia, I really appreciate that. It's very helpful to understand that there's a difference between the approach involved in impact investing and that involved in ESG investing. And we're going to talk about that more. But there was one thing that you mentioned that I want to follow up on, first with you and then from Jeff. And that's the idea that there's a demand that you sense. There's a desire for impact investing. Can you talk a little bit about where you see that emanating from? Is it a different type of client? Is it a different generation of client? Or is it a client that moved away from ESG and wanted the alignment you talked about and yet didn't want to give up financial returns, and impact investing does more for them than mere ESG investing did?
A great question, John. We at Elevas, we are focused on women. And what we're seeing is a lot of demand from our clients for this kind of investing. I know we're going to talk about this a little bit later, but our industry has been talking a lot about this great wealth transfer and the transfer of wealth from the baby boomer generation to younger generations. There's also the great wealth transfer, which I think has been overlooked. A lot of the beneficiaries of the great wealth transfer actually will transfer to women first, simply because women live longer. And sometimes, not just a couple years longer, but could be a decade or more longer. So that wealth transfer, assuming it goes largely to women first and then to younger generations, what we're seeing is women and younger generations actually want to be more intentional about their money. Not only about spending, we see that on the spending side, but we also see it on the investing side. So clients will come to us and they may be their parents, left them an inheritance, and they will literally say, while I really appreciate the inheritance that I've received, as I look through the portfolio, I do not want to own these things. And so that is where the demand is coming from, is they are, and we see this with other things in the generation where they value things like experiences over things, for example. And I think that thread is actually, investing is actually part of that thread, is really looking more closely at what the investment actually is and what is the impact of that investment and whether that aligns with their own values or not. And so regardless of what the environment is, I do feel that there is kind of this new wave of investors, both women and younger generations, that want to invest differently. They may not be satisfied with just investing in a portfolio of, index ETFs or what have you, is that they really want to understand the impact of the investments that they have and really lean into that.
Jeff, when you hear Sylvia talk about that demand, you're out there meeting folks who are looking for these investment opportunities. Are you seeing those same people, or are you seeing yet another demographic that you can look at and say they really want impact investing as well?
So I think Sylvia hit on the big trends with the great wealth transfer, specifically women, and then the next generation after that. But I'm going to throw in two other categories that I think should be highly considered. And by the way, lest you think us men are pigs, believe it or not, there's still actually, I think it's 65% of men especially older men, still are interested in aligning their values, but not nearly at the same level as Sylvia just talked about. But one area specifically that I would focus on, and this is not so much on the investor side, but I'll get there in a second, and that is the wealth advisor. And the reason why I say that is the wealth advisor starting to recognize more and more about not only this great wealth transfer, but then the hyper personalization that investors are now. We're used to hyper personalization in most other assets or aspects of our lives. The investing world has put this wall in between us and said, hey, you're going to buy this basket of stocks that called an ETF or whatever. You barely even know what's in there. And so the smart wealth advisors, not to say that you don't do this, you're not smart, they're seeing this trend, and there's a real demand from the advisors saying, I need to figure this out because of the trends that Sylvia just mentioned. The other thing we're seeing is there's another subset here that candidly don't care about the impact per se, but they believe in the investment theses that are out there. I'll give you a great example. And this is true of a lot, but let's just say regenerative agriculture. If I were to change the vernacular and not call it regenerative agriculture, because that slants one way or one frame of thought, if I were to say innovative agriculture for the next generation, whatever, believe it or not, both of those are true. And so we are finding people who are getting interested in regenerative ag, as an example, and they're not even into it for the impact side. They're into it because they understand that the science and the proven results that regenerative ag can produce above and beyond traditional farmland that's worthy of an investment. It's just an investment trend or investment thesis. So look, the purist in me, I was in the alternative space, John, with you for 20 years at a company. And so when I came over to impact investing, I would have focused very much on this impact investing theme. And that's still who we are and what we're about. But I actually probably spend more time talking about the investment merits and thesis, which actually makes sense because that's what people want to invest in. And if I really care about the impact, if I don't have solid financial models, then the impact is not sustainable, which I deeply care about. So those are just two kind of nuances or not nuances, but additional driving appetite for impact is the wealth advisor. And then in investors, we're just looking for unique alternative investment plays. And we'll see, and if we have time, we'll talk about it. My experience has been on this side of the industry for the last 8 to 9 years. And I'm not going to name drop on what I used to do, but we worked with some of the largest asset managers in the world, literally. I am seeing as much creativity and innovation in the impact space as I saw in traditional finance, which is shocking to most people.
I think, Jeff, you make a really, really great point about how investors, and we have some investors who are, 100% leaning into impact, and some that is really a nice to have. And so having the investment merits is critical in all of those cases. And I think with impact, obviously, I think we can all agree that there are a lot of gaps in this world, gaps to fill, whether you're talking about, affordable housing and, how much more demand there is than supply, economic inequity, there's a lot of social and environmental issues there. And I think where impact investing plays in is impact investing is really trying to, in many ways, close those gaps while making a financial return. And I feel that where the gaps are largest are actually where the largest financial opportunities are, because these are places where they're overlooked. Everyone's chasing the AI trade, for example. I'm not really seeing a gap there, for example, but things like affordable housing, it's going to be a very, very long time before that gap is being filled. And so from a pure financial perspective, I agree with you. Anytime that there is a gap to be filled, there's a financial opportunity there. And also with new technologies, anytime you can do something better for cheaper, and it happens to be have some positive impact, whether it's environmental or whatever, it doesn't really matter. Like if you're not if you're not an impact investor, or if that's secondary to you, I think everyone would agree that having a service or a product that delivers better results at less, even if it has a positive impact, is a great thing. It's a win-win in many cases. So I think it's easy to lose sight, because a lot of impact investors get excited about the actual impact of the better outcomes, but I don't want to lose sight of the fact that there is I think, a significant financial opportunity in this space.
So let's stay on that idea or that theme, Sylvia, if you don't mind. I assume you can't just sit back and expect those opportunities to be brought to you. So how do you make sure you're in the flow of, and like Jeff, I want you to talk on the same subject when Sylvia's done, but Sylvia, how do you find the deals? How do you make yourself known to be looking for them? And where are you looking to make sure you're seeing deals that meet this somewhat, I think, precise definition of an impact investment, where you have both a financial opportunity that's meaningful, real financial potential, as well as the ability to align values with your own?
Great question, John. It's a lot of work. And as you said, they don't just fall into your lap. I think, finding these unique types of investments that offer both the financial return and some kind of positive impact, it's just a lot of boots on the ground. It's connecting with like-minded investors like Jeff. Jeff, and I have known each other for many years. It's getting into that community of other impact investors. It's talking to all kinds of asset management firms, whether they're impact or not, letting them know, hey, these are the kinds of investments with these kinds of criteria that I'm looking for. And I found that planting those seeds, and we've been doing this for almost 10 years now, but those first few years were very difficult, and we found far and few kinds of, and we only had like a few options for our clients that we felt really delivered on the financial returns and the impact. But it's really planting those seeds. And now today, we're getting a lot more inflow, because we're now known as impact investors. And so when there are fund managers who are raising, they also want to have investors who are like-minded. And so often we will be, in their crosshairs in terms of that. But it's just really, it's a lot of boots on the ground. It's just connecting with other like-minded investors, connecting with fund managers, letting them know, what you're looking for in terms of both returns and impact.
I want to get to you, Jeff, in a second, but Sylvia, maybe a naive question. Do you have managers bringing you impact and non-impact flavors of the same deal?
Absolutely. And here's where I think we can be very collaborative. So just to give you an example, we had a manager, a private credit manager that I've known for many years. They were raising their fourth and fifth fund, so very strong track record in the space. And when we looked at their portfolio companies, we noticed that a larger percentage of them than on average were going to underrepresented business owners, like women, people of color, et cetera. And so I started talking to the manager, and I said, hey, I really love your strategy. You have a great track record. You have a strong, sustainable investment process. But, gosh, I would really love it even more if we could create something that only focuses on those underrepresented business owners. And so it took about a year, but we basically created a special purpose vehicle, an SPV, that kind of invested alongside the main fund. But basically it was a vehicle where all of the portfolio companies and the loans in that portfolio would be led or managed by women, people of color, and LGBTQIA plus persons. And so I think that's an example of just working with managers, they didn't, have that impact mandate. But kind of just looking at through their portfolios, I noticed, hey, these particular businesses are actually performing quite well, and then working creatively to actually have that impact mandate. And so we're actually, starting to replicate this with other managers as well. But I think it's just another way that I think our industry can really collaborate to meet the needs of our clients.
Terrific. And Jeff, are you, from where you sit, are you running into firms that understand what Sylvia is talking about and are getting there themselves? Or do they need a catalyst? Do they need your firm or somebody in Sylvia's position to give them the push that makes them really study whether they could sort of add an impact element to what they're doing?
Yeah, so I guess I'm 8, 9 years into this transition from traditional alternative investments to impact investing, and so it's been a shift over that time period. And for another day, we could walk through what's happened in that transition. But common good capital is known. That's all we do is impact investments. So we get sought out from generally asset managers who have been an asset manager maybe in their prior life, and then they've switched that over to an impact methodology or process. And so they're coming to us saying, hey, we want to create this fund. We want to do it with these impact metrics. We will help them with that. Sometimes just helping them create it. Sometimes it's helping them raise capital. So if you were to talk to our CFA, who comes from the alternative space, Stephen Hester, he's great. There is not a problem of not having enough options. If I had to shake a magic wand, I would say we would like these funds to be a little bit bigger, and that's really obviously a scale or velocity, because as you can get a little more scale, then everything, the profitability, the expense ratios, all that stuff are just easier to meet. So it's really around aggregating the demand together and then putting that demand into where the opportunities are. And that has dramatically shifted over the last 8 to 9 years. We're still not early in impact investing, but we're still early in some of that. But I mean, we deal with many fund managers who are on they could be on their first fund. Generally, they have experience though. But there's plenty of asset managers. They're on the third, fourth fund, and so it's exciting to see. And the other thing I'll tell you is, and this is not to speak ill of anything I did in my prior career or anything that other financial professionals have been or are doing, but a general comment that we hear from the asset management side of the business is, I just wanted to do something more meaningful. And you say, well, what do you mean by that? Well, and I'm going to be very crude. I'm just sick of making money for the rich guy at the top or whoever. And so intuitively, even at these asset management shops, they recognize that there's more to investing than just making money for the investors and just making money for the companies. And so, I mean, I've had many people like, I want to do something that I'm passionate about. I want to actually leave a legacy. And so when people wake up and go, I can actually invest the world a better place, investors get return. Absolutely. And so that's going to be another big wave that's going to happen. And especially, I mean, I get calls all the time because there's not that many who do what we do, who are like, I want to do an internship. Can you help connect me? Because people want to have meaning in their work. And I would say, I think COVID really impacted that. I could give other examples, but I think people are like, I don't want to just whine about problems. Let me be a part of this. So, and this is a simple way to be part of the solution. The last thing I'll just say around this is me preaching a little bit, but it's what I believe. going out and analyzing and finding impact investments is, and maybe I just drunk the Kool-Aid. It is so invigorating and so fun because you get to see so many unique asset managers, and they have a broader palette of tools to deliver results. And so they honestly, they can think more creatively. So, I mean, I would tell you, I wake up every day. Now you still have the headache of being an entrepreneur and all that stuff. But man, to know that you're really trying to make a difference in the lives of how capital's invested is amazing. The other thing that most people don't think about in the impact space, which almost draws me into it more, when you open up your metaphorically and your portfolio to say, hey, what if I invest not only for my own benefit, but what if I invest in things that, because I care about affordability, I care about whatever it is. And this sounds weird in the investing world, but being connected to your capital in that way from an investor perspective is really quite fun. And it really is a pleasure to be able to invest in this stuff. My wife is into what we invest in way more than anything we did before. And everything I do this company, all upstanding, great people. I'll give an example. And again, this is not to speak ill of anything, but look, I don't really care to own another Marriott hotel real estate. Nothing wrong at all with that. You need that for a thriving economy. On the other hand, to be able to invest in renewable energy in Africa, unlocking access to power for people who don't have access to power, like for my wife and I, that's the kind of stuff we would like to do. And contrary to what people might think, you actually can generate real nice returns. And because in that example, there's often misunderstanding, and Sylvia said this earlier, we actually think you might be able to get outsized returns right now because of the ignorance and fear of others.
Yeah, I just want to follow up on something that Jeff said. I love how, Jeff, you were commenting on how many asset managers are kind of coming and feeling like, hey, I love what I do, but I think there can be something more in terms of meaningful. And you hinted on this a bit already, Jeff, but the flip side of that is certainly the client engagement. And I think clients, at least our clients, both men and women, by the way, we don't just have women clients, love this way of investing. And when we do our quarterly reviews, they will quickly move through the financial performance and they want to get to what they call the good stuff, which is, how is my investment doing from an impact perspective? They love hearing the stories. They love even some of the quantitative measurements. And that really has meaning for them. And it's also a great client engagement, and it really strengthens the client relationship.
So Sylvia, you and Jeff both talked about the idea that there's not a trade-off of necessarily lower returns. There might even be higher returns depending on the program or the product. So if it's not a matter of trading off returns to achieve impact, what is the trade-off? I mean, I think both of you are saying not every investment, not every manager, not every opportunity presents an impact investing option. So if not, why not? What is it that either the sponsor or the investor needs to understand in order to not see this as kind of too good to be true? What's missing from something that doesn't go the impact route that would represent a trade-off, something that's not there if you want to be in the impact space?
I truly believe there is no trade-off if you choose not to make a trade-off. So I am certainly not saying that every investment that is impact oriented can drive competitive returns. Just like you have to be picky about all of your investments and doing the due diligence, like not all technology companies are the same, for example. You have to decide, you have to intentionally decide, I'm looking for competitive financial returns alongside impact. And so taking that entire universe of impact investing and really narrowing it down to those criteria, just like with any other investment It's got to have the financial characteristics, the risk and return characteristics that are competitive within that asset class. I think there's just a really great example of an investment strategy that actually we found through Jeff and his team. Fantastic story. I know it's something that our clients would really love, where we're trying to solve, address, the lack of housing in a third world country, and at the same time, we are actually the strategy is doing it in such a way that it is lifting up communities economically and sending them, on their way to being middle class, for example. We were doing a lot of due diligence. It was fantastic. The returns were right solidly in the double-digit net IRRs. And then recently we learned they also had a different share class, which was concessionary. And we had to make the decision, and we said, you know what, we're not at all interested in the concessionary share class. It's a decision that you have to make. It doesn't mean that there's a trade-off here. It's basically an intentional decision not to do. And so we are passing on that share class. We are passing on this investment. We are exploring other avenues, through some collaboration, but we are passing on that, even though we absolutely love the impact. We know our clients will love the impact, but we are choosing not to accept a lower return. And so that's how I think impact investing should be. I mean, and there are certainly many investors who want to do impact at a lower return, and that's a trade-off that they will have to make for themselves. But for us, that's just not the kind of investing that we are doing for our clients.
I want to come back and ask you a little bit about how you get some assurance, let's just call it that, some assurance that the impact criteria will be followed, will be carried out, that your manager will not buy something inconsistent or develop something inconsistent with the impact mandate that you thought you were funding. But before we do that, Jeff, is there anything about the process of talking to people about the impact space in which you have to tell them, yes, it's harder. You have to think differently. You have to look at opportunities that you may not have looked at before. Is there something common to the thinking or contemplation part of this process in which you really have to answer the question, how is it different, by saying you got to approach it differently and you got to work a little harder, smarter, different, more X or Y? Is there anything that falls in that category that you've seen consistently when talking to managers?
So in thinking about your question, because my background was in non-traded REITs, non-traded BDCs, working with many different managers, at one level, and this is probably where there's a lot of misunderstanding, we use the same analysis on the investment side that hopefully every institutional due diligence, asset manager uses when they're evaluating this. The thing that we do is we add in this idea of, hey, let's be intentional about driving impact across whatever it may be. And so with that, you have to actually slow down. You can't make quick judgments. It forces you to say, let me really understand this from a 360 degrees. And what you'll find oftentimes is like, oh, there's this one little thing over here. So for example, what Sylvia just mentioned, believe it or not, there are investments out there where there are foundations, there are family offices, there's other types of organizations that are trying to drive impact. They at times will come in and be first loss capital for investors. When have you seen that in the traditional investing world? They actually will come in and say, look, we're going to give this capital to this asset manager. I'm making that as an example. It's going to be a 4% kind of loan, but they'll say, if investors don't get their capital back, we'll take the first loss out of our loan position. And they go, why in the heck would somebody do that? Well, because they, believe in the asset manager and believe in the theme, and they know that if they can get more capital into this space, it'll make it more efficient and can drive, greater impact and hopefully greater returns. The other thing, it's a lot of this is mindset. So, this idea of, and Sylvia brought this up earlier, um, this idea that if I'm going to give up something, and and what people are implying is if I do good, that's going to cost me. If you really ponder that for a second, that's quite disgusting. That's actually what goes through somebody's head. Because then my reverse question to them is, so your mutual fund, your ETF that just did 25% return, did it somehow do something bad to make that happen? No. So it's very binary thinking. And in fact, when you understand the situation, oftentimes what you'll find is that by taking a more holistic view, taking a longer term approach, caring about people, well, there's people in every investment, that oftentimes that will drive maybe not a better return, at times a better return, but you know what it might do? It might reduce the risk. Well, you reduce the risk of the same return, that's still a better investment in my perspective, or at least should win an allocation. So a lot of this is mindset. A lot of it is if you look at the financial world, just look what's happened. I mean, I sat at the middle of ETFs being created in Chicago, Illinois, when I was there with a unit investment trust firm, and then it switched to ETFs. And if you think about where like ETFs, and this is not negative towards them, but generally you just own, you don't even care what you own. You just know you own this ticker symbol with 2,000 stocks, 500 stocks, or whatever. And they're distancing themselves so that investors know what they want. So there's almost this natural inclination today to go, we don't really want to tell you what we invest in because we don't really want the full transparency, and we don't want to answer questions. And impact investing is the other way, going, no, dig in, understand this stuff. And in fact, see the stories behind it, see how it's making a difference. And oh, by the way, if it's not making a difference in the returns, or it's not generating the impact, that needs to be told, because then you'll say it's not working like we thought. Maybe we need to try this or that. Last thing, and then I'll stop preaching. So I personally have made, and my wife and I have made investments in several affordable housing opportunities. Go to COVID across all of multifamily, it was a struggle. Well, in the case of one of our funds, they actually stopped distributions. And they stopped distributions and told everybody and said, we're not going to pay distributions right now. We think we're going to be fine, but we really want to help transition these residents through this process. So we got engaged with what was happening. Now, if I was a retiree and needed that capital, that's one thing. But on the other hand, to be able to say, you know what? We treated those residents and they helped through the transition. Well, guess what? It's paying a distribution again. And oh, by the way, one could argue you probably have raving fans and have less turnover in that asset today than you would if you had just immediately kicked everybody out. And if you kick somebody out thoughtfully, that somehow you're not impact either. It's just posing these questions. What's the right way to do this? And it's, if nothing else, just ask those tough questions before automatically, well, somebody's not paying rent, so I'm going to kick them out. There may be, bringing a nonprofit, and they subsidize that for a window or whatnot. So just a little bit of rambling there, but there's those are just some of my thoughts.
It's useful and helpful to hear them because it really sets up another related question, and I'll ask Sylvia to address it. And that's, all right, so you hear these terrific ideas, you see or hear about great attempts at kind of providing the returns that people want, but with the impact that they want to have at the same time. So where does this all get reflected? What are the places? Is this in just conversations with the manager, Sylvia, or does this show up in other things, in offering documents that firms can essentially be held accountable for, or marketing materials that they have to at least stand behind when and if somebody's asking the questions and they're providing the answers? Where do you see the impact investing promises getting made?
That's a great question, John. I think there's a wide range at least in our experience, where we see the impact promise being made. I think Jeff had brought up something very early on in his earliest remarks about intent, and that impact investing is very much the intent of making an impact is very much a part of the strategy itself. That's where I see it really showing up. I've certainly seen investment strategies where there's not an intent, but it's really more of a byproduct. Like, hey, we do this, and oh, by the way, it actually is, a little bit, energy efficient or whatever the thing is, but the intent wasn't there to drive that outcome. It was really a byproduct, and that's for me very often where I draw the line. And you had an earlier question, John, about, hey, how do you ensure that the fund manager is going to abide by their impact mandate and not go off and do something that's kind of outside of what the expectations were. And I think that again comes to the due diligence of the manager and really understanding, what is the manager's motivation here, and are they really like-minded? And there's some incredible, as Jeff mentioned, like this is such a fun part of our job, because it's incredible to see innovation in the space, asset managers, entrepreneurs, really doing some incredible work that is not only an incredible financial opportunity, but also really moving the needle on some of these things. And so I think you can learn a lot by having multiple conversations with these managers to determine, hey, if they're really, really focused on trying to close this gap, I have complete trust that they're not going to be going off and now, going from affordable housing to, luxury, apartments in New York City or what have you. If it's a byproduct, then I don't have that same confidence. Now, I don't see, if you're talking about, private placement memorandums and things like that, you're not, at least I don't see big sections kind of devoted to impact and things like that. It is mentioned as part of the investment strategy. And, we are trying to address, the gap between, supply and demand for housing, for example. There's never a promise, I think there's always like a goal, kind of like, oh, yes, there's an expected target return of X. And, there's an expected, impact, impacting 1,000 lives or something like that. But it's not, a promise or a guarantee. It's really an intent, just like there's an intent of driving financial returns. And that's really kind of where I see it being delivered amongst impact managers.
Jeff, I'm going to have the same question for you, but Sylvia, have you seen or encountered a manager that says, look, I can maintain the financial projections that we talked about when you came in, but I'm going to have to change aspects of the program or the fund in order to meet them that will give us a much smaller impact, a much lower, lesser, smaller footprint in the impact that you wanted when you came in? Does that conversation occur where it's that explicit, where the question is, which is more important, the return or the impact, or is that something that really hasn't really come to the surface in kind of what you're seeing in the marketplace?
I haven't seen that amongst our asset managers yet. Doesn't mean it can happen, but I haven't seen it in our experience.
Hey, Jeff, do you have any different experience in the firms you're talking to? Do they ask you, hey, if I need to maintain my financial goals, do I have flexibility on delivering on the impact side? Or again, is that just not something that you take into contemplation at the front end because your intentionality doesn't really allow for that circumstance?
So oftentimes the investment thesis is so directly tied to the impact that it doesn't, it may come up on the fringes. And I'm trying to think of an example. Affordable housing. How much do we increase rent? Do we evict people? How quickly do we evict people? Like, those are fringe, important, but that's not changing the investment thesis of, hey, we're investing in preserving affordable housing. for generations. So I would say if you're finding that as a big conflict, no offense to the asset manager, you probably know which way they fall. Now, there's also a pragmatic side to this too. So I think on the impact side, if you go to a certain subset, they're so worried about getting everything perfect on the impact side that they don't do anything because it's like, wait, So I think one of the phrases that a coach, a business coach, used to always say, and I think it's right, especially in this case, is progress, not perfection. So oftentimes it's you just want to know that you're going in the right direction. Then you have some really interesting discussions. Is it better to invest in a small manager, a small fund that probably is more impactful unit for unit, or is it more impactful to invest with a large asset manager who maybe is not putting all the bells and whistles on impact, but I'm making this up, but 50% of the impact they're doing, and they're gonna quadruple the amount of impact because of their size. That's the fun part about impact investing is you can decide, and that's why it's, to me, it's not ESG related. You know what you're going to invest in. You know what the impact they're trying to drive. There's plenty of options. If you want to do it, you do it. If you don't want to do it, you don't do it. It's there's nothing hidden, and in fact, the more transparent, the better. So it's funny. So I go back to my time, at CNL when we did non-traded REITs, non-traded BDCs, and you're asking legitimate questions. Well, is the measurement right, and is it fair? And I want to look at everything and go, hey, I was in the room 15 years ago when you couldn't even have sponsors agree on how to report on certain metrics in the non-traded REIT space. And so be careful, not you, but be careful that, like, oh my gosh, impact investing is so far behind because they don't have these metrics. I would tell you in that short time, I actually see impact investing driving for more transparency quicker than I ever saw on the traditional side. And that's not to speak ill of the traditional, because I had a career there and I'm grateful for it. But when you were trying to do good with the investments, there should be a natural proclivity to have transparency and show people what's happening, because you want financial results, because if you get financial results, you're going to get people investing. And then if you're getting impact results, well, that's almost like gravy, and you get more and more people there. So yeah, it's a very interesting space. This is not all linear. That's why I think it's important. You got to really dig in, and you really got to ask a lot of questions, and even ask some hypotheticals. Okay, so if this happens and could be a trade-off, asset manager, how would you think about that? How would you deal with that? Ask those questions. And if they don't have good answers, then that probably tells you much chances are they probably got some thoughtful answers. That's why they're doing this.
I think part of what underlies your answer is something both of you have referenced, which is measurement, benchmarking. You can call it what you want, but there is an accountability that I think many folks found to be missing from the ESG space that both of you argue is or should be in the impact investing space. So with that, Sylvia, I'll start with you. Are the benchmarks the same? Do you use different tools or just supplemental tools to measure financial performance and impact separately? Or is it still a combined metric of sort of overall success, and then you talk about the impact investing piece as a supplement, I think as an add-on, as you were calling it, Jeff?
I think this question of measurement is always a challenging one. We haven't completely figured it out. I think it's something that is continuously evolving. So the approach that we take when it comes to impact investing is, because we are focused on competitive returns alongside impact, we measure ourselves against other assets that are in kind of that same asset class. And so, for example, if we have an impact focused venture fund, for example, we expect that fund to drive venture like returns in mid 20s and above, that kind of thing. And that's how, when all said and done, how we're going to measure the success from a financial perspective. Same with affordable housing. That's multifamily housing. So it should drive the same kinds of returns that we would see from other multifamily, whether it's affordable or not, types of strategies. So really kind of keeping within kind of the asset class and using that same benchmark or measurement that we would with any investment impact or not within that asset class. We also, the fund manager themselves will often have a target, IRR, target return, sometimes a target yields and distributions. And so we will also measure against those targets as well as part of the full financial picture. The impact piece, because there's such a wide range of impact, some things can be quantified, some can't. We tried a long time ago to produce kind of a cohesive impact report, which we did for a couple of years, but it was difficult because each manager may measure differently. And so it's not quite apples to apples kinds of things. And so we use a combination there of quantitative measurement as well as kind of qualitative, some of the stories and things like that, as a means of highlighting the impact from the investments. So that's where we are today. It's not perfect by any means, but we're continuously looking at ways, how do we, as there's not a single standard, even in the ESG world of how to measure this. And I think everybody who is in this space is always looking for better ways to do this, as we are.
Just so I understand, is it to say that you don't have a economic or financial performance metric for the portfolio that's traded, and then you say, now let's talk about the private non-traded impact part of our portfolio? Or do you, in fact, try to divide your presentations into those two different segments?
We do divide things at a high level based on asset class. And so the publicly traded equity portfolio, for example, will have those standard benchmarks that we use, MSCI, et cetera, global benchmarks as we use as a measurement, similar for fixed income if a client has a portfolio of municipal bonds. And we also do have a municipal bond impact strategy. It is measured against the same benchmarks as a ladder of municipal bonds or a bond ETF, for example. And then this kind of bucket of alternatives and private markets, because that's almost like a portfolio within a portfolio, right? Because we've got some private credit in there, some private equity, there's real assets, and there's not like one measurement that's going to qualify. And that's where we kind of divide into each sub-asset class and measure that way.
Jeff, almost a slightly different take on that same question. Do you think, as there's been a lot of impetus on bringing privates to the retail space, even to the retirement space, is impact investing going to sort of be a part of that drive to make the privates part of everybody's portfolio, even if they were long thought to really only be for high net worth investors?
So first of all, when I think about impact investing, and generally I'm talking about private impact investing, it is no different than any traditional alt that I've ever been a part of, other than this impact component. So to the extent that with this new push to get alternatives into 401ks and all that kind of stuff, do I think impact will follow? 100%. The bigger question will just be how mature, how quickly can this industry grow and meet the scalability requirements to keep up. But if you just go back to what Sylvia started with, which is the huge demand driver of this massive wealth transfer, absolutely, it'll follow. I mean, anecdotally, I'll give you an example because we talk to wealth advisors all across the United States. This is not just one or two, we will come across a number of advisors either that have lost a client or that have inherited a client because that next generation is leaving their mom and dad's asset manager because they cannot address this impact investing sleeve. So, and I also think, and I know because I used to have hair before I started this, the large asset managers, as this becomes more mainstream, they will absolutely jump into this space in a bigger and bigger way. It's just a matter of matching the demand with with the product availability. And I have only seen, contrary to the labeling of this webinar, I have only seen increase in the demand for impact investing, not the other way around. Now, it does require a little explaining, like we talked about, but that's why in some of my discussions, I don't even necessarily talk about impact investing. I'll just talk about some amazing investment opportunities that have great investment return things, whether it's regenerative farming or whether it's renewable energy, that we're doing. And what's so funny too is that just the vernacular you use massively impacts how people view this. I think as vernacular becomes more commonplace and things start to line up a little bit more and there's less confusion, I think it'll just continue to grow.
Well, I want to thank both of you for all the time and effort you put into this today, and I'm going to give you each a chance to kind of give me your final thoughts, really on the title, as you mentioned, Jeff, of our webinar, which is impact investing. Is it washed up or is it evolving? I think I've heard from both of you. You see it evolving, hardly washed up when you see the demand that you talk about, and the interest on the sponsor side in bringing products to market to meet that demand. But as you look forward, as you see what might be on our ADISA stages, what might be in product development, what might be in the legal and regulatory environment, Sylvia, I'll start with you. What factors are going to drive the next phase, if you will, of growth in impact investing? Will it be the demand side, or will it be the ability of the sponsors to really build the products that people want to buy and whose financial advisors want to put them into?
I believe it's 100% on the demand side. I believe that with this great wealth transfer that's underway already, we're already seeing it for clients. Jeff alluded to that, clients who are leaving their spouse's financial advisor or their parents' financial advisor, not because they weren't great advisors, is because they want to invest in a different way, and those advisors are not able to address that. So I think the demand is there, and I do believe that the asset management industry will follow that demand, but I don't think that they're going to be leading it.
So, Jeff, people are going to come to your firm and ask you how to be part of the world that meets that demand. What are you going to be telling them? What are you going to be looking to help them do?
I'm very happy to report that the collaboration that I see in the impact space is top notch. So I actually believe that if you look at the growth trajectory of impact investing relative to traditional alternatives, it wouldn't surprise me if it ultimately has a faster uptake. Rather than view this as work, a liability, actually catch a wave of where this thing is heading. I think you're going to see early movers, continue to see early movers, and I think you have a disproportionate opportunity to grab market share. I look at her firm, and without a doubt, I know because I talk to other wealth advisors in the space, and it's like, you need to talk to Ellevest. Why? Because they've built out a lot of this. And so I'm assuming that's part of the thesis why Ellevest created what they created, and I think they are in a good spot. So, and then the other thing I would just say is, if you claim an impact investment firm, not that you got to be perfect, but if you are incongruent with that in any way, I think it'll get sniffed out. On the other hand, if you truly, that is your ethos, you can see it. So for example, I would be very cautious of an asset manager who's never cared about impact, all of a sudden says, oh, I'm going to do impact, my knee jerk reaction would be like, I'm going to be cautious and wait and see. And it doesn't mean that they can't, and it doesn't mean that they're not wonderful people, but there's a huge learning curve that needs to be had. And I think so. I think you got to have the right questions, but I think you need to be very mindful. And I'm not saying this to protect any territory or whatnot. I just know I've had these discussions with asset managers who want to get into this space, and it's like, not really your ethos. So because of that, I think you'll see more partnering that'll have to be done. Anecdotally, we have a very, very large asset manager that's come to us at Common Good. Don't know if we'll win it or not. And if I said the name, everybody would know them. They came to us seeking out us as a potential sub-advisor to do an impact fund to funds. So just that, anecdotally, where's this thing going? Well, we actually have a large asset manager in the traditional asset manager space, great people, never done this before. They recognize they probably shouldn't go on their own. One, they don't have the expertise, and then two, probably doesn't really fit at least how the marketplace knows them today.
Well, that really does count as the last word, but a terrific last word from you, Jeff. So thank you both. Thank you, Sylvia Kwan, CEO and CIO of Elevest, Jeff Schaefer, CEO of Common Good Capital, and to everybody who tuned in today, thank you for your time and your interest. I hope you can count on more of this from the stage as Jeff and people like Sylvia help us continue to bring impact investing ideas to our conferences, to our events, to the exhibit room, maybe even the TNDDA stage, if that works out for some managers. And we hope that this has engaged you and you come back to ADISA for more on important topics whenever they are things you want to learn more about. Thank you again.